Good morning. I'm Eddie Sunderji, and welcome to OETV's Cryptodome. We are joined by Adam Blumberg, co-founder at Interaxis. Adam, how are you, mate?
I'm great. I put on my fake smile this morning.
So
It's awesome. Yeah,
it's
again, like unfortunately, always something to talk about in crypto, and there's a whole lot to talk about. Well, I say there's one thing to talk about. It's just it goes in a lot of different places.
we are the Cryptodome, and I feel like SBF or FTX, however you want to classify them at this point, are in the Thunderdome with the regulators and government bodies and all sorts of things going on right now. It's it's not really that funny, but it's just a mess, dude. Like, why don't we just break it down to 60-second kind of like 60 second. um what happened, Adam?
Yeah, I don't know. You and I talked about it last week, and at the
Yeah.
point you and I talked last week, that was the point where we thought Binance was going to buy FTX. Right? We were still in that mode, and I think it was probably 2 hours after we talked that we found out that they were not going to do it. That likely it was just a charade. It was CZ kind of getting to pretend to be the White Knight and then not do it. I'm fairly certain that he knew that they weren't going to go buy FTX. There was nothing there left to buy, and there was no reason to do it. What we found since then has just been pretty mind-boggling in terms of the level of it. It was in this case just poor risk management, right? When we look at things like Celsius and Voyager, that was absolutely poor risk management. That was people thinking crypto would always go up, and they were going to leverage customer deposits to earn more yield. This was outright fraud. That's exactly what this is. So what happened, just to go back, and this is from my understanding. I've read a lot of things. I've listened to a lot of things. I've tried to keep up as much as I could without going completely insane and angry and throwing things. I've thrown a few things. I'll give you that. But the essence of it is those who used FTX, and keep in mind this is FTX International, not necessarily FTX US, because those are different. Those who are using FTX International for trading or for holding their assets or for buying their assets, those user funds, the funds that I deposit there, potentially, well, I don't deposit because I'm in the US and that would be illegal for me to do so. Let's just say that I live elsewhere outside of the US and I deposit funds with FTX. They were using those and lending them to Alameda Research, which is Sam Bankman-Fried's other company that is a hedge fund, trading firm, all those things. Alameda Research was losing money, so they were getting loans from FTX, and those loans happen to be user funds, user deposits, with the thought that this is how Alameda would get back to profitability or get back to positive. That's kind of the easy gist of it. There's a lot more nuance to it. Little things like apparently Sam had actually built in a backdoor into the software code. This is what makes it so much more fraudulent. One is the user agreement says they can't use my funds for any, they have to hold them in their treasury. It says they're not allowed to do that, and they did it. Two, to satisfy regulators and to satisfy everybody else, they would look at the code. They would, regulators would look at the wallets and the accounts and say, does this match up with the amount in user accounts? Yes, it does. Okay, you're good. They built a back door in the software to make it look like the reserves were there while they were siphoning off money to go send over to Alameda Research. So this was premeditated fraud.
That's
I don't know, like there's no other way to put it. It's premeditated fraud. It's really bad. It's bad for a whole lot of people. I was asked Friday in my class, is there any silver lining? It's hard right now to come up with a whole lot of silver lining. I'm quite sure I could. And that silver lining, as you know, is probably going to go towards DeFi and the technology and the transparency and all those things we should have had here. But the fact that so many people lost so much money, it's going to be hard to find a silver lining
and it's kind of, there's been a lot of different conversations punted around this. The fact that you've got all these young people, and I'd like to classify myself as a young person at
We'll give
heart
it
as
to you.
well. Youngsters who have started in this crypto universe, right? And I'm talking to someone who's a veteran in the financial industry, 25 years. We've seen how finance works, right? There's risk parameters around everything, whether on an equity trading side, whatever it is, there are structures around risk management. And obviously, those have intensified since the financial crisis as well. And we've learned from our mistakes, and the government bodies and regulators have come in to kind of enforce and enhance those guardrails. I don't know if you saw it, but on Monday, Scott Duxbury, my colleague, was on Column E, kicking off the week, and he was getting very, very passionate about the regulation around crypto and the lack of. And we've seen none of this kind of come to fruition as it should. And maybe this has been this is a kick in the regulators behind that, we're begging and asking for something to have some structure. That's one part, right? The other part is we've seen the crypto asset universe just explode, right? So you've got these young kids who have come in, they start off with a few $1,000s. Next thing you know, it's a multi-billion-dollar platform, and they're handling thousands of people's customers' assets. These kids don't know what they're doing. They're way over their skis, right? They have, they haven't necessarily. They're just super smart kids who could be great coders, who could just super smart kids, right? But they don't necessarily have any background or anything and it doesn't have to be in the financial world, but running a business, running risk management. Whether you're a grocery store, you've got inventory management. You have these different tools that you learn while building a business and running a business. These guys have gone from 0 to 6,000 in months or years, and there's no way they can, have the real qualifications to be able to manage these things.
Yeah, I completely agree. Look, you're right in my wheelhouse now, right? This is why we're training financial professionals to learn this. You need some people who understand things like cash flow and treasury management and risk management in the room, because things don't always go up. Things, move down sometimes. You have bad economies. Look, crypto has never had a down economy, right? Like, it was born out of 2008. And this is the first time we've seen it in a poor economy. So we have to see how that works. The other part you mentioned, Mehdi, is risk management. Risk management across the board, especially in the centralized players, has been atrocious. It's been horrible. It's been this feeling of it's always going to go up. There's always going to be someone there, and there's no thought of we need to protect ourselves for a rainy day. We need to protect ourselves for when things go bad. More importantly, there's been no thought of we need to protect client funds for when things go bad. There's been this constant feeling of this will always go up, and we can risk manage around ourselves. The other problem, Eddie, and we can go back to the talk about regulation as well, but the other problem I want to make sure I get out there is the systemic risk in crypto is so much tighter than in traditional finance. What I mean by that is what we saw earlier this year when Terra blew up, right? Or this is going way back to April when Terra blew up, and that caused Bitcoin to drop, right? Terra wasn't really associated with Bitcoin other than they happen to own a lot of Bitcoin. And then that blew up Celsius and Voyager, and that blew up hedge funds. And that's kind of what's leading to this, because Alameda lost so much money after the Terra debacle, right? But you would have to look across the entire ecosystem to see that systemic risk falling, to see what's going to happen to me down the road, having my money in what I think is a regulated entity like FTX. I feel like I'm pretty safe. I don't realize how that's going to affect me. Or something like we'll talk about in a moment, probably Gemini Earn. Well, Gemini Earn is I deposit something like a stable coin and I earn some interest rate. Well, that seems to be having issues now. So the systemic risk is staggering. And people need to understand, we need financial professionals to understand how it works, to get in there and help those that, as you said, are really good at coding and really good at building these systems and these incentive systems and everything. But we need someone who's good at risk management and treasury management and cash flows and all those things that we've seen in business. As you said, if you've run a business for a while, you have to understand cash flow is king. That's the most important thing to manage.
Well, and if we look at the traditional financial systems, right? If I deposit $100 at my bank, right, there's JP Morgan, I drop $100 off, JP Morgan isn't going to hold that $100 on my behalf in case I need it for a rainy day. They will be lending that out. They'll be, utilizing that $100 to try and generate more in revenue for JP Morgan, right? And JP Morgan shareholders. The difference is that I have a comfort zone knowing that it's FDIC insured up to a certain amount, obviously, as an individual, right? But right. I'm happy for JP Morgan to go out and lend that out because I know I have some sort of insurance on the back of that. We've seen crypto assets, I deposit $100 in FTX or whichever exchange and I buy some Bitcoin. It's being custodied within, whichever my exchange that I'm using is. Now, what they do with that is very different, right? They're basically, there's lending protocols, there's leverage protocols, there's all sorts of things that go on which allow my effective $100 to be lent out and utilized elsewhere, but I have no claims on my $100 if anything goes wrong. And that's, and I think Coinbase kind of stepped in and said they're one for one, managing their custody, which ultimately is saying they're not lending out any of your assets. And people who utilize Coinbase should feel comfort in the fact that if I have a deposit of one Bitcoin, I can go and get my one Bitcoin because it's not being lent out. There's nothing being done against it.
Right.
Whereas that was not the case in FTX.
Right. And honestly, Mehdi, like that's in the big run up in crypto, that was a problem that Coinbase has. People were saying, why can't I get more leverage? Why can't I get more yield or something? And now Coinbase is saying, sorry, like we were being boring. You guys didn't like us on the move up. Now you love us, right? Because now we're the ones who keep your money safe. That's the whole point here, right? Is we're kind of operating like a bank, which says we're going to make sure that your money's still here. As you mentioned, if I put my money in the bank right now, I know they're going to go lend it out, but I know there's so much regulation wrapped around that I can feel pretty comfortable. Of course, we can go back to 2008, and we know that banks weren't being safe with our money. They were being completely risky with our money. And that $250,000 of FDIC insurance didn't kick in because the government bailed out the banks anyway, right? Which is what gave us Bitcoin to begin with, this frustration that the banks did something they weren't supposed to do. They put us all at risk. The government bailed them out anyway, which, by the way, is our tax dollars at work, bailing out the banks. And then they can kind of go do the same things, right? Then we're just going to put more regulation and more regulation and more regulation. So if we go back to our regulation talk, where I think we started this line of thinking here, is do we need more regulation? Do we need different regulation? What does it look like? Let's remember one thing. FTX International was headquartered in the Bahamas. It was not headquartered in the US, okay? And they were headquartered in the Bahamas for a reason, because they didn't want to play nice with US regulators. FTX US didn't, at the time didn't have those problems. Later on, they kind of had those problems. But one of the reasons why Coinbase and Gemini and Kraken and such don't have those kinds of issues is because they're heavily regulated in the US and they're playing nice with regulators. Okay, so FTX International was, there's very little that I think US regulators could have done because they're not based here. They're purposely not based in the US. So all they could have done is what they did actually was say, if I'm a US citizen, I can't deposit money there. Okay, if I'm a US entity, I can't deposit money there. It's really simple. If I go to FTX.com, if I went to FTX.com a month ago, 2 weeks ago, if I went to FTX.com, it would have said, it seems like you're in the US, you can't deposit anything here. Okay, that's kind of the extent of it. What other regulation do you want? They already kind of say that you can't take user funds. So what other regulation do you want there? I think we agree. I think centralized exchanges need to be regulated, kind of like banks a little bit, to say that here are the things you can do, here are the things you cannot do for people to feel safe. I don't want that regulation to trickle down to decentralized finance. I don't want it to be all over the crypto industry and stifle the innovation. There has to be something for the centralized players. And then you kind of have to let DeFi play, because as I've said in all these kind of calamities, DeFi is still working really well.
It is, but there's got to be one hand talking to the other on a global basis. right?
Yep.
We're now talking about this Chapter 11. The only reason the US apparently is even allowed to be involved is the fact that Alameda is they're registered in Delaware. So when they filed for bankruptcy, that obviously brought in the US regulators and
Right.
government governing bodies. So that's the only reason they're actually even enabled to be in these conversations with FTX, because otherwise it would just be the Bahamian government, which what happens there, right? So this is going to be such a complicated, drawn out bankruptcy, and while this is going on, all it's doing is putting pressure on crypto, just from a reputational kind of asset. And we're now seeing people, the likes of Charlie Munger, come out and throw in his, he was on CNBC yesterday, with his 2 cents of it's just fraud and it's this and delusional. I don't know. He came out with some crazy statements yesterday on CNBC, but that's Charlie Munger, and that universe is going to carry on. But I will say Michael Saylor came out with an interesting statement saying that Bitcoin's almost kind of removing itself from a lot of these crypto assets just by virtue of
there's a lot of what I've seen from whatever time I've spent online. I've tried to spend as little as possible through all this, because again, it angers me and frustrates me. But what I've seen is there are a lot of people who are kind of Bitcoin maximalists or Bitcoin only kind of people that have said, okay, look, this is what we started with. It's only Bitcoin. You should only have Bitcoin. Part of this, remember, is because FTX launched a token called FTT, which was utilized by traders to get discounts and everything. So it had value. And a huge portion of Alameda's of Alameda Research and FTX's books, a huge portion of their assets were the FTT token. And the FTT token, was kind of one of those things, like it had value because people traded it and they thought it had value, right? And you wonder, does it really have value? It's a cryptocurrency, it's a crypto asset. So a lot of the Bitcoin people are saying, see, they created that token. It's a big problem. You shouldn't have any other tokens but Bitcoin. Bitcoin should be the one. And we're seeing a lot of that. And of course, Saylor's going to say that. It's his baby at this point. And by the way, he's, as far as I know, getting closer to that point where he's going to have to come up with some more money. I think like 13,000 I read is the next level, but don't quote me on that. Anyway, I think there's more of a move, instead of just Bitcoin only, which a lot of people are going to, more of a move towards self-custody, more of a move away from exchanges and going, look, the whole point of this technology was not to have to count on anybody else to hold it or to ask permission to move it around. That was the whole point of this. And we need to go back to that ethos of, I want to hold on to my own crypto, whether it's Bitcoin or ETH or US dollar coin or DAI or whatever it might be. I want to hold on to it myself. That is what I'm seeing more people go back to. The company Ledger that makes hard wallets, makes little hard wallet devices, has had 2 record weeks in a row for their sales. Right. So people are going back to that. And hopefully, Mehdi, hopefully, and I know, like I said, I don't know if I can find a silver lining here, but hopefully we're getting back to this, getting away from this idea of this is meant for speculation and everyone's going to go raise 10 and 20 and $30 million to try to figure out how to buy crypto and leverage it up and hedge it and all those other things, and just go, let's just build the system and see what happens when people start using it. See what we actually need when people start using it, because what we don't need is the 82nd different perpetuals or the 82nd different derivatives platform on DeFi. What we need is easier user adoption, easier user experience. That's what we need.
So that's, and I feel like I agree with you on that. And I feel like the exchanges felt they were giving that easier user experience. And that's kind of where we ended up. So now, there's got to be, someone's got to help access, be the rails, do something, right? Because if I want to go and buy my Tesla tomorrow, how can I do that in a simple manner, right? And I'm, obviously there are ways, and but for Joe Blogs on the street who wants to do it in Bitcoin, it was easier utilizing, whether it's a Coinbase wallet or whatever it is. That's the structure that kind of has come into play over the last few years, and it's what's also supported the rise of the crypto industry is becoming more easily accessible to the general public. We're now going backwards, and to go forwards, we've got to find a better way of doing it. And that's where the next question is: how do we
And it might be, I don't know, it might be a little painful, and it might be difficult to get there. And what you're probably going to see is fewer people becoming overnight millionaires because they launched some code and then they go raise $10 million. Okay, because here, I'll go back just a little bit because I want to get to your point about how we move forward, right? But let's go back here to the poor risk management. What we've also seen with FTX and with Alameda and all these is incredibly poor due diligence on the part of the companies that should have known better. So VCs that didn't do their due diligence, hedge funds, all these funds that didn't do their due diligence on SBF and on FTX, because they said he seems like a nice guy, he seems altruistic, he seems like he really wants to help the world. And by the way, that company invested. I'm sure you read the things from Sequoia that basically they were like, we really like this guy, we like what he had to say, he seems genuine, let's throw him a whole bunch of money. That doesn't make a whole lot of sense. Because what happens, yeah, when I see that Sequoia invested, I'm like, oh, well, they probably did their due diligence, I've outsourced it to them. Well, they didn't do it. They forgot to look under the hood. There were some that looked under the hood and saw problems. We can go on Twitter and find people from months ago that were saying, I think FTX has a problem. And here's why. And I think what we're going to do is move more towards people who have that understanding. So the financial service firms, the financial professional firms that do things like due diligence and audits and such are going to have to start employing people who understand on-chain analytics, who understand how to look at wallets, understand how to follow those kinds of money flows, and work together with those who understand cash flow and treasury management to figure out how we're going to audit. So if you wonder how we're going to start moving forward, the way we're going to start moving forward is try to go a little bit slower, try to stop breaking so many things, right? And try to make it a decent user experience and go back to kind of what got you here and the point of decentralization, right? Go back to some of those, that ethos. And we can go, some of us that aren't quite as young can go back to the early days of like the internet and go, man, it was painful to try to get email set up. Remember, every time you switch service providers, you got a new email address. Like there was no Gmail early on. So that kind of stuff was painful. Connecting a web browser plus dial-up or something was painful, but you did it. And eventually we got here. And the problem is when you have all these exchanges getting people into crypto, they got you right into the equivalent of what we see today with computers and the internet, which is I buy a laptop, I open it up, and I expect it to be powered up and find a Wi-Fi immediately. And if I'm not online within 3 minutes of buying my laptop, I'm frustrated at this point, right? But in the early days, it wasn't like that. There wasn't as much safety and security. You had to protect yourself a lot more. We're going to have to go kind of back to those days a little bit where maybe it's a little painful to figure out what needs to be there. And then you go, all right, we're going to start onboarding people, but do so in a way that's safe and secure and goes along with the ethos of what we're trying to do. And not everyone has to earn 182% yield. And not everyone has to have a token go up 100x. And quite honestly, not everyone needs a token.
Yeah, I'm very inclined to agree with you, and I think that going backwards to go forwards is going to create a more stable environment for everyone concerned, and that's how we can build on this infrastructure and take it to the next level.
Yeah, and I'm gonna hang around for it because I've come this far. Help educate people, help teach people, help if we can help educate regulators so they don't just take a hammer and knock it all down. Happy to do that, but that's the key, is people need to learn about it to the point that they can keep themselves safe, that they understand they're not trying to speculate here. This is a different way to hold your money. It's a different way to have more people around the world participate in the economic system, not a get-rich-quick scheme.
So Adam, I think that kind of, there's going to be a lot of fallout from this over the next several weeks, months, who knows, years, the way this thing's looking at this point. So I'm sure it'll be coming up again in future Cryptodome conversations. But we're staying on top of it. We'll keep an eye out, and we'll always throw in our 2 cents on how we think people should be kind of looking at these things. And obviously, it comes down to education, which is something very near and dear to your heart. And that's not just from a personal retail investor or an institutional investor. It also goes to the regulators. It's, at the end, the more we educate ourselves and the better we position ourselves from an understanding of what we're investing in, the better we're all going to do. And, to our viewers, I advise you to come and check out the courses at InterAxis.
All right, Mehdi, thanks. We'll still be here talking about it. We'll still discuss it all. I think our topics will change a little bit, but like I'm still excited to be a part of this. I think it's still important. This is a huge monster setback, but it's just a setback. The technology is not going away.
One step backwards, but we'll hopefully go 2 steps forwards. Until next time, my friend, thank you for sharing your thoughts on Cryptodome. And to our viewers,
thank you for having me.
And thank you for being here. And thank you for watching, and good luck investing.